Hey, everybody, welcome to this week's Fireside Chat. My name is Coburn Sheppick. Always happy to be with you. Today, we're going to be discussing approaching the market cycle. We are coming to the beginning of a new cycle, which can be very exciting. It's also going to be very tough for a lot of people that have taken risks in the last few years, potentially. So we've been talking about in recent meetings some of the reminders of what distress looks like, how it occurs, where to find it, and what type of opportunities will come out of this potential time. So I'm excited about this conversation. We're really talking about here today as far as how we are approaching this cycle, some of the deals that we're going to be focused on, what to look out for, and I think that you'll find this fascinating, as well as getting to know us a little bit better. So let's get going here. Some of the topics that we want to talk about, I want to do a quick introduction on Dovetail, and then I want to, we usually do our state of the market. If you've been on recent meetings, the conversation is remaining the same, but we want to just, highlight the changes as they go, the updates. So if you've been on recent calls last week, the conversation might sound similar, but this economy that we're in is at a very challenging point, and so we want to keep having this conversation and also cover any updates. So then we'll dive into our subject here of approaching the market cycle, and then at the end here, I've got an invite that I'm excited to share with you. So let's dive into it. A little bit about Dovetail. Dovetail is a private investment firm that makes principal investments using its own capital and capital raised from outside sophisticated investors, primarily into commercial real estate assets. So we aligned with seasoned operating partners to strategically place capital and leverage our expertise to structure the risk away from ourselves and our investors. We are not operators. We are focused on vetting and locating quality, the best-in-class opportunities with the best-in-class operating partners. So our duty is to locate and vet the best operators in certain sectors or that are focused on certain sub-asset classes when we're talking about commercial real estate. So the best industrial operators, the best developers, the best multifamily operators, and we let the operators do what they do best at developing and operating the day-to-day of that specific deal. We are the equity partners, we're allocators. And so our goal is to, we've spent months now structuring our business to be able to invest at your discretion. And the way that we have this structured is, once these opportunities that we're going to be talking about today start to appear, we have the structure and the foundation to move very quickly, unlike a lot of the offices that are out there. So some of we're focused on primarily growth markets. We're biased towards industrial, multifamily, although multifamily has been so inflated over the last few years, we've sort of had our pens down, but the opportunities that will come with multifamily are huge, and we'll talk about that a little bit today. Most of our investments are Class A development, and moving into this cycle, there's going to be a lot of opportunistic, distressed scenarios, and that will be focused on sort of the restructuring, which we'll get into that as well. So let's talk about the state of the market. And as you know, we are at a period of time where inflation is at one of the highest points in history, at least over the past 40 plus years. So it was in the late 70s, early 80s, where inflation got out of control. That was the last period of time where we've experienced something like this before. way before my time. And the Fed is now learning the mistakes that had happened during that period of time, which, looking back in history, in the 80s and in the great financial crisis, 2007, 2008, the Fed was tightening policy, lifting rates, one small chunk at a time, 25 basis points, or 15, in some cases, over a long period of time. And looking back at the 80s, this did not work. It was too late. And so there was a period of time, a stagflationary period of time that inflation was stuck. And that's not what the Fed wants to do. So there's a different, more aggressive approach in this cycle, and that's the rapid increases of 375 basis points year to date. There's another meeting with Jerome Powell just here in a few days, a couple days, and we'll be hearing the latest as it relates to interest rates, and we're expecting a 50 basis point hike again, which is another big jump. And based on what we've heard, based on what we know, we think that rates will continue to rise at lower paces in Q1 and throughout next year potentially. But for sure, rates will remain elevated compared to what they've been historically, which was nearly zero for years. And on that note, that is what happens when the cost of capital is cheap. There's a saying, I don't know exactly how it sounds, but millionaires are created when capital comes cheap, a lot of them. And those who can operate when capital is not cheap are the ones that'll stay alive. So the housing market, we're not into residential, but the housing market plays a key role in the economy. And as you know, a lot of markets have gone up dramatically. I'm in Phoenix, and the residential real estate market exploded, got super high up bid in value. And over the last few years, especially, there's houses in my neighborhood that have went from the 200s to the 400s in what seemed like a very, very short amount of time. And that was beyond that was just in the last few years. So keep in mind that a cycle is on average about every decade, every 10 years. And so what we had gone through up until this point is one of the longest expansionary periods in history. So already the economy is hot, and then COVID happens, the economy shuts down, stimulus is pumped in the market, interest rates drop, and that's where this expansionary period, although we went through a period of the shortest economic down period in time when the pandemic hit, because the economy was shut down. It was so fast, and the amount of money that was printed and pumped into the economy basically just extended this expansionary period. And here we are today, and we're going to be paying for this. So are we in a recession? Are we going into a recession? We have this conversation all the time. It's a gray area. A lot of people would say we are in a recession, looking at the historical definitions of negative GDP over 2 quarters. And so we are, based on that definition, in a recession. Although it has not been called yet, we think that next, for sure, very, very likely that in the next few months that will be called, and we will be entering an actual recession. So let's dive into our subject here, which is our approach to this cycle. Now, a few points that I want to talk about here. What we are looking for, and we are pens down at the moment because we know what is very, very likely to come, is the timing. Okay. I was on a call with some incredible people a couple of weeks ago, and someone said, we were all laughing, but it's so true. And someone said the best time to enter a building is when it's smoldering. The fire's put out, the bankruptcies are cleared, the bodies are pulled, but the building is still smoking. And this is so true. So on the other hand, it was just, a few short years ago where a lot of assets were inflated, meaning that the values got expanded a ton, cap rates compressed dramatically, and operators were buying, a lot of new operators were buying multifamily deals, for example, value add stuff at 5 caps. And if you know anything about real estate, paying a 5 cap on a value add, 60s multifamily building is overpaying for an asset. And we've seen a ton of that. And so the timing to this, and nobody can time the bottom of a market, of course, but what we can see is the signals, and we can see actual scenarios. So we're already seeing some of the signals. All right, just to back up, some of the prior signals that we've seen in the past couple of months are negative leverage, meaning that the cap rate is, the buy-in cap rate is less than the debt cost, and that is a huge red flag. And now, so what we're seeing just a few months ago and today, negative yield, and now we're starting to see some creative types of deals come up, assumable loans, which is one of the first sort of signals. And so we'll see a lot of assumable loans, commercial loans, where operators are trying to unload these assets, just take over the loan. And we'll also see some creative financing where there's going to be some sellers that are willing to carry a portion back. Basically, what's going to happen is these operators who have acquired at the top of the market are going to do what they can to creatively get out of the deal and recoup their losses. And if they don't, they're going to be unwinding and having some very very shameful times with their investors, which is terrible. And what this is going to do is it's going to create a lot of consolidation. A lot of people took too much risk, and it's going to leave a very, very once in a lifetime opportunity for groups like us to come in and restructure and get in at the best time of this, again, once in a lifetime opportunity to begin the news cycle. And so moving on to the next point here, this is where we focus on the basis. It's always one of the main focuses, aside from great operators, is what our buy-in is. So real estate is, when you make real money in real estate is when you buy. I know you've heard that before, but it seems like a lot of buyers, a lot of acquisitions sort of lost sight of the fundamentals over the last few years, buying these value add deals at 5 caps, for example. We want a healthy basis, and we're willing to wait for that healthy basis because we want to take advantage of the entire upcoming cycle. So looking back, a lot of new operators were buying at the top of the market. Cycle is now coming to an end, and now they're stuck in this position of needing to exit these short-term deals. They didn't have enough time, and most importantly, they did not enter at a low enough basis. And so that leads me to my next point, which is deal sourcing. A lot of what we've seen is, people, it seems like a lot of newbie investors look at real estate like you would, and I was just wrote an email about this. Look at real estate like you would shopping at a traditional store. Get on LoopNet and look at and find a good deal, underwrite everything. It's just not how it is. It's much more complex. And so, the way that we are sourcing deals is by, one, via our network, most importantly. So we are looking for We are constantly looking for new operators. And by why I say new operators is because certain an amazing operator might not be active all the time. So we need a network of operators that are vetted, and what I mean by vetted is they have real track records in their area of expertise. So that means the sub asset class, the market, and have a successful track record in operating in that specific niche for at least 2 down cycles. And so 2008 would be one of those down cycles that we want to see, because these cycles happen, and not only in real estate, but in stocks, in our lives, these cycles happen. And there is, although looking back at 2008, a lot of people lost their ass, but also there was plenty of operators who were smart with the timing, understood the basis that they were buying at, and were able to navigate and do what they need to do to successfully navigate through that downturn period. And so we are constantly seeking incredible operating partners in all aspects of the market. So in Phoenix, for example, in Texas, in Florida, in Vegas, we want operators that have boots on the ground, that have real track records, and that understand how to buy and what that basis should be focused on. So outside of that, that is our main sourcing of deals. And we also, the network is, quality opportunities are really first presented to a very select few. So we are proud of our network. We're constantly growing our network. And for anybody out there that's trying to source deals, that is the answer. And so what we like to, one of our biggest values is having the ability for investors to tap our network and to invest directly into these deals. We're not structuring funds, we're not pooling, we're not cross-collateralizing. We are giving the ability for investors to directly invest in these opportunities. And so this is our approach, and we are focused on certain growth markets, Class A assets. There's going to be some restructuring opportunities, and there's going to be a lot of scenarios where, again, newer or even vetted operators have made risky decisions over the past handful of years. They're over leveraged at this point, and they have they're stuck in a position where they have to unload this asset somehow, or they're going to get in a pinch. And that's where we can come in and help restructure the equity and take advantage of some of those opportunities. So as far as the timing of all this, things take time. And so if we look back in history, it was 2005, and most people don't think that anything was happening in the real estate market until 2007, 2008. Well, 2005, that's when the Fed started tightening policy. And so if you look at history in that sense, it took 2005, 2006, and 2007 for the bankruptcies and the foreclosures to really start to pile up. So that was 3 years where it took for the real pain to hit. And then if you got in 2010, for example, and that period was slow. So it was 2008, 2009, 2010, even 11. And so there's a 3-4 year period where the market was really hurt and this mess was made. And those that came in and restructured those deals and took advantage of that opportunity are now, if they've held up until this point, until the last couple of years, they've had the best run in history. And so that is the goal. The goal is to wait for opportunities to come, not jump into deals to keep up the deal flow. We want to wait for these opportunities that'll come from this tightening, come from what has happened with inflation, come from what's happened with rates rising and policy changing, and wait for that all to unfold, which we know that these opportunities will come. So we need to wait. And a lot of people out there that look at real estate, there's this strange sort of overly optimistic approach of, why wait? We need to, don't wait to invest in real estate, right? Invest in real estate and wait. That's what a lot of people, a lot of younger operators would say. And that's false, because we know in real estate, you make money when you buy. And so the projections, the rent increases, the exit cap, that's all, it's all assumptions. It's all projections. What is true is what we're buying today based on the market value. And we need a discount based on today's market value, so we can be profitable through the holding period and have a reasonable assumption on our exit based on today's value. So that's the real fundamentals. And aside from that, we need a healthy spread between cap rates and interest rates. And that today does still not exist. And we'll start to see cap rates decompress. We're already seeing it, not dramatically, but this is very, very early in this down cycle. So we will see a huge correction. We know that, and we're pretty optimistic on that statement. And this time right now for the next few months is preparation. And so that'll lead me into my last slide here of we want to open up our network, invite new investors in that'll have the ability to invest directly with our operating partners at their discretion. This is not a fund. And we think the opportunities that'll come are, again, this type of cycle where we've had a period of 12 years basically of expansion, and it during the last 3, it's sort of it was like no other, because of how low the lowest ever point, the cheapest debt, and a lot of free money that was printed over the past few years inflated these assets. And we will have the most one of the most opportunistic periods of time, I think, and the opportunities that'll come from this are absolutely huge. So we want to invite you in. There's no commitments. There's no costs. We want to invite you into the group so you can have access to be able to see what we're working on and get notified for the opportunities that are coming. We are taking soft commitments right now. You don't need to, but it helps us gauge who's involved and wants to have sort of a first insight on what's to come. So we are actively taking soft commitments. It's pretty easy to do. You can just log in, create an account, jump on a call with myself or one of our team members, and basically just suggest, kind of put in a note like, I'm interested in investing this. And so we can hold your place for when these opportunities start to come in, which we expect them to do in the next handful of months. And that way you can have first look on what's to come. So regardless, if you don't want to do a soft commitment, that's totally fine, but I want to invite you in to join our investor list. You can go to our website, join the wait list, or even better yet, actually register for the portal, which would be, our website is dovetailig.com/register, or you can just go to our website and click on the investor portal button at the top and register for the portal so you can have first insight on some of these opportunistic opportunities that are coming, just a matter of time. So thank you for your time today. You can also shoot us an email if you want to just set up a call with us. You can reach us at partners@dovetail.ig.com. That's partners@dovetail.ig.com. Thank you so much for your time today. What's to come. I'm very excited about, and I'll leave it at this. These life, real estate, the economy, everything runs in cycles. And so there is a lot of people from the last period, last cycle we went through, a lot of people came into it with fear because of what had happened. Devastating things had happened. People lost their retirement. People lost their houses. People lost their jobs. And so what came out of it was a lot of fear. And there's a very, very, very select few that understand how these cycles work. It's a cleanse, okay, in the economy. And what follows, just like anything positive and negative, what follows this downturn, and when you understand what to look for as far as the signals, and once again, keep this phrase in mind: when the smoke is clearing, right? The bodies are pulled out, the foreclosures are cleared, the bankruptcies are cleared, the property is still smoking. That is the time we want to enter an investment. And this is going to be, we're not just focused on real estate, we're focused on businesses as well. And these opportunities are going to be all over the place. But there's going to be a very select few that are not focused on fear, but are focused on the new cycle. And so I want to invite you to be a part of that, to take advantage of the opportunities that will be once in a lifetime. Thank you so much for your time today. My name is Coburn Sheppick. Stay in the loop for our, we've got the holidays coming up, but we're going to do one more. We're going to do another call next week, and then we'll come back. We'll notify everybody when we're going to come back after the holidays. So join us next week, Thursday. You'll see an email, and I look forward to that conversation as well. In the meantime, have a great weekend. Thank you so much. Cheers.